One of the biggest investments a company will make is in their plant assets. Now, the term plant assets came from a long time ago when companies used to have big factories. We called them production plants. Today, when we talk about plant assets, we're really talking about resources of the company that have physical substance. In other words, you can touch and feel these assets. They're used specifically for the operations of the business and not for resale. And the whole idea of these assets is that they will last longer than a year, with the exception of land that may last forever. Now, typically, these assets will be labeled on a financial statement as plant and equipment, or property, plant, and equipment, or even the term fixed assets. So in other words, you need to be flexible when you read a financial statement that you see any of these terms, they're talking about plant assets. Now, companies will have different degrees of plant assets depending upon the type of work they perform. For instance, a fast food restaurant like Wendy's will have a significant amount of plant assets, whereas a retail store like Walmart will have less plant assets since they don't manufacture anything and really don't require a lot of property, plant, and equipment. And even a further extreme is a company like Microsoft, who manufactures software. In today's software industry, software is developed, and provided to the end user electronically, and very little physical substance resources are ever required. So how do we account for the cost of plant assets? We use the historical cost principle to determine what the cost of an asset is. So when we look at an asset, we look at the purchase price of the asset plus any additional expenditure to get that asset into its intended use. Now, when we use our expenditures and we look at what we spend for our assets, there are two types of expenditures. One called a revenue expenditure and the other is called a capital expenditure. Revenue expenditures have an immediate impact and they are therefore expensed in the period that they are incurred. A capital expenditure, such as for a plant asset, will have an intended use of multiple years, and therefore we need to capitalize the expenditure and place it on the balance sheet and spread the cost of the asset over the life of the asset. So when we say cost, how do we determine cost? Well, the cost of an asset is the cash paid in a cash transaction or the cash equivalent price paid. So in other words, it's what we paid for it, or if we gave up another asset, we have to look at what the fair value of the asset given up or the fair value of the asset received in order to determine what the cost is. If we're looking at the exchange of something other than cash, what we have to do is to figure out which one's easier to figure out. The fair value of the asset given up or the fair value of the asset received. So if one of the assets that we considered as plant assets is land. So when we look at land, how do we determine the cost of land? It's all the necessary costs in order to get the land ready for its intended use. So for instance, we would want to include the purchase price, attorney's fees and title fees, real estate brokers' commissions, property taxes, or any other cost to get that land ready for what we're using it for. For instance, if I had a purchase of a piece of land with a building on it, but my intent was to build a brand new building on that property, the cost of the asset would include the purchase of the land in that building. However, that building is going to be knocked down because we didn't want the old building, we wanted to build a new building. So we would apply the purchase price of the land and that old building into just the cost of the land. In fact, because the intended use of the land is to be set up so that it can build a new building, the cost to knock down the old building is included in the cost of the land. So you can see that land is going to include the purchase price, all those additional costs to get it to a condition that you plan on using that land for. So here's an illustration. Assume that Hayes Manufacturing Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is razed at a net cost of $6,000, which is $7,500 cost less $1,500 for the salvage of the materials from the knockdown warehouse. Additional expenditures are the attorney's fees of $1,000 and the real estate broker's commission. So, determine the amount to be reported as the cost of the land. Well, what we just said was that it's the purchase price, the $100,000, plus the cost to knock down the old building, which is $7,500. We have to reduce the cost by $1,500 because we were able to sell the salvage materials. Also, we have to include the attorney's fees for $1,000 and the real estate broker's commissions for $8,000. So all those items would be included in the computation of cost. So altogether, the cost of the land is $115,000. Now, another type of plant asset is called land improvements. Now, sometimes we mistake in land improvements for land, but think of this as the items that we put on the land to make the land better. Things like driveways, parking lots, fences, landscaping, underground sprinklers, even trees and shrubs. Because we look at these items differently from land because ultimately they're going to wear out and they have limited useful lives. Therefore, we want to keep the cost of land improvements separate from land because land improvements will depreciate while land does not. Another plant asset is buildings. Now, we all know what a building is. However, there are different types of costs for the building. One cost of the building is if it's an existing building that we're buying together with land. If it's an existing building and we're intending to use the existing building as included with the purchase of the land, we will have to allocate the purchase price between land and building. Now, in some cases, that'll also include the cost of closing, which are the attorney's fees, title insurance, and other costs, and real estate commissions. Also, if the intended use is to be used and we have to spend money to improve or remodel the building to get it to its intended use, those costs would also be included in the cost of the purchase. Now, there are times when we will build our own building. If we build our own building, all the expenditures related to the construction are included in the cost of the building. Now, if we had expenditures related to preparing the land, those costs will be part of the land. But once we start the construction of the building, all those expenditures like architects, permits, excavation, the labor from the workers who are building the building, all those costs are the cost of the building. Another type of plant assets is equipment. Now, equipment is things that you're familiar with. If you're a manufacturer, it could be the drills, it could be the table saws. If you're a retail store, it could be your cash registers and all your display items. So every company will have different types of equipment. However, the concept is that equipment's cost is the purchase price plus the sales tax, freight, insurance, and any other cost to get the item into its intended use. If you're buying something used that needs to be repaired, those expenditures for repair, if the item was already broken and you're repairing it to get to its intended use, are part of the cost of the asset. So here's an example. Lenard Company purchases a delivery truck at a cash price of $22,000. Related expenditures were the sales tax, the painting and lettering, the motor vehicle licensing fees, and a 3-year accident insurance policy of $1,600. Compute the cost of delivery truck. Notice, the cost to get it to its intended use was the purchase price, the sales tax, the painting, and the lettering. We do not include the accident insurance policy into the cost of the delivery truck because the insurance isn't to get it into its intended use, it's going to be used for its normal operations. So therefore, the accident insurance policy is not included in the cost of the delivery truck. So here's the journal entry that we would make for the purchase. Debit the equipment for $23,820. Debit the license expense for the one period for $80. Debit the prepaid insurance for $1,600 and credit cash for $25,500. Remember that prepaid insurance policy we talked about earlier will be spread over the life of the insurance policy. So next the question comes up is, should you buy or lease? Now that sometimes is a philosophical decision that management has to make. A lease is a contractual agreement in which the owner of an asset allows another party to use the asset for a period of time at an agreed price. Now some of you have already experienced lease in the acquisition of your car. A lot of times people will buy a car but they can't afford a car, so instead of going to a bank to ask for financing, they go to a leasing company to lease the car. Initially what happens is that it's easier to lease a car because there is a lot less cash related to the acquisition of the asset. However, the problem you run into in some lease arrangements is that at the end of the lease, you do not own the vehicle. So the question then is, should you lease or not? Some of the advantages to leasing is that now you don't have to worry about obsolescence of the asset because at the end of the lease you give it back. 2, there's little or no cash down payment required because the leasing company purchases the asset for you and then in turn you make payments for the asset until the end of the lease term. Normally the owner of the asset, the lessor, has the tax advantages in this transaction. However, that can be negotiated between the lessor and lessee, and both parties can share the tax advantages depending upon how the contract's written. Now once again, depending upon how the contract's written, the accounting treatment will be different. There are 2 types of leases that need to be accounted for. One is an operating lease. The other is a capital lease. An operating lease where the company that leases to the user maintains ownership and charges the fee for usage. And the expenditure for the charge for the usage is treated as an expense on the lessee's income statement. There is no asset on the lessee's balance sheet because it's an operating lease. Now, if the lease is termed a capital lease will be an asset on the lessee's balance sheet, and the lessee will be able to take depreciation on the asset even though it's a lease transaction. Now, the determination of an operating lease or a capital lease is beyond the scope of this class. However, just keep in mind that there are 2 different leases and the accounting treatment's different.